For the first time since 1994 to start a year, 28 years ago, major stock averages and government bonds were both down at this point in the year. What do you make of that?
Morning, Brian. Yeah, it's an environment of that the market has to accept the Fed has to go faster in tightening than the previous cycles. And it does remind you of what happened in 94, even though the economy was very different at that time, with one similarity, and that's inflation, right, which is about the same now as back in 94. So the market, the bond market, and the stock market both have to accept that the Fed has to go higher than where we ended up last time. It seems to be indicating something maybe around 3%, but could be even 3.5% on the funds rate. So I think the Treasury yields, as you're seeing this morning again, up at 286. We're going to hit soon probably 3%. We're not far away from that, and my guess is we're going to go back to where we were in 2018 at 3.25%. So that's going to continue to put some pressure on the stock market too. That's the broad market, but I think within the stock market, there's a lot of interesting opportunities, both on the bull and the bear side. So I think this is the environment: lower stocks, higher yields.
Well, we'll get to those opportunities in just one second. I want to quickly follow up on that since we're talking about 1994, which was a major rate hiking environment. I think the Fed raised rates 2.5% in 1994. I guess maybe some good news for our audience is that in 1995, and I'm pulling the numbers out of the air, so you'll forgive me if they're not perfect, the Dow rose about 33%. So just because we're in this kind of environment, does that necessarily mean the market can't later on do well? Or is this a very different situation?
Well, I think there's some analogy to 95. I mean, what happened then too was that the Fed just simply took enough action to get that inflation rate back down. And that is still in the bond market too. If you look at inflation expectations, they haven't really broken out so materially. So there's some expectation that, yes, the Fed has to move the Fed funds rate up much higher, but it doesn't mean that inflation, therefore, cannot moderate over time. I think that is the scenario from 95. You get moderating inflation next year. That is your soothing backdrop to the stock market ultimately. So I think we could be heading that way, Brian. Caveat is here, of course, as you mentioned in the opening segment, we do have this Ukraine situation still very lingering. We could put a lot of pressure on the energy markets, right? So that's your inflation story.
Yeah, there was no war in Southern Europe in 1994, at least in Ukraine anyway, and energy rocketing higher now, unlike 94. You said interesting opportunities, Ben, out there. Where are some of those opportunities as you see them now?
I look at several things, Brian. I think that one, the energy market continues to be, in play. And if you look at, for example, oil servicing companies versus big oil, there's a huge gap in valuation. You would think that oil prices don't really come off so far, let's say all the way back to $50 a barrel or so, despite all the efforts to try to clean up supply. So I think big oil companies are, undervalued relative to servicing. Then we deal with the reopening. We've talked about many times now, but the global reopening is still there. China will reopen as well too. So I think that's the other play at the moment in the airlines and hotels and leisure sector.